If you are thinking about taking some profits in stocks, but you're not willing to park your money in cash, earning next to nothing, this video is for you. Because right now, one of the highest probability big long-term opportunities in the markets isn't being talked about enough, and that is US interest rates. And I'm not talking about the Fed funds rate, who everyone knows is going lower in the near term. I'm talking about the 5 to 10 year part of the curve. US 10-year Treasury bonds are still sitting near 4% now, and retails are not paying enough attention to it because it's not as exciting as stocks. However, this setup currently sits at a turning point, and it's exactly the kind of long-term trade that big money moves into before the headline catches up. So in this video, I'll break down exactly why long-term bond yields are still high but not for long, and why now this is the time to take advantage of that when the market is still in a false sense of fear. So take a look at this chart right here. This chart shows the 10-year US Treasury real yields over the past 2 decades. Now you can see that we are actually at an all-time high real yield of 2.4%. This means that you're actually getting paid 2.4% over inflation to hold these long-term bonds. And why is this an opportunity of the decade? Because look, inflation expectations are already coming down, and these yields wouldn't last once growth actually starts slowing down. And the reason why yields are still at this level now is because of fear in the markets. And I'll show you why these fears will not hold up for long. Now here's a history lesson nobody on YouTube seems to mention. Every time bonds suffered a lost decade, like from 1940s to 1970s, it was followed by decades of strong real returns, as that's when yields actually peaked. Notice that in early 1980s, yields were at all-time highs, but after that, we had years of bond yields starting to grind lower, and bonds had superb returns. Look at where we are today. Early 2020s, the returns were deeply negative. Why? Because we had COVID, we had rates starting from zero. Of course, the years after that is going to produce negative returns. And we had almost the worst stretch for bonds in almost 100 years. So historically, this kind of drawdown is the setup for strong returns in years to come, not weak returns. When everyone calls this a bond trap, this is when, the sentiment will quietly and slowly flip, because the higher the starting yield, usually the better your forward returns once disinflation and rate cuts start to kick in. So to show you why I think 10-year interest rates are going down, let's look at what actually makes up the 10-year interest rates. There's really only 2 variables that matter, and I took this right from the Fed's website. First, what's the average short-term rate you expect over the next decade? And second, how much term premium, or in plain English, how uncertain and volatile you think interest rates will be over the next 10 years. Now, let's look at the first part, average short-term rate. You can think of this as a proxy for the Fed's fund rate. When you hear people say the Fed is cutting or the Fed is on hold, that is what they're really referring to. So the question is, will the Fed continue cutting rates over the next few years? To answer that, let's go straight to the source again. The Fed's own dual mandate, maximum employment and stable prices. And right now, arguably the biggest uncertainty that can affect these mandates is the impact of AI. So on one hand, we are already seeing signs that employment is weakening, especially in the tech sector. Thousands of jobs have been cut across software, hardware and startups. Layoffs in Silicon Valley have been increasing and very real. These are just the facts. Now, you can argue whether or not AI is a bubble. I have given my own take on that. But here's the beauty of buying long-term bonds right now. And that is, it doesn't matter. If you believe that AI is not a bubble, then these job losses are just early casualties of automation. And over time, companies will become more productive, unit costs will fall, and all this is disinflationary. And if inflation drops, the Fed can stay easy for longer, long-term yields will be lower. On the other hand, if you're skeptical and think that all this is a bubble, and a lot of these layoffs are just cost-cutting or offshoring disguised as AI efficiency, then when the bubble pops, risk asset will sell off, unemployment will spike. And what does the Fed do when unemployment spikes? They have to cut harder to contain the damage. So, two very different stories as to how AI will play out, but the same one destination, and that is lower long-term yields. So if you've watched this far, congratulations, because you're probably a serious investor that looks beyond the hype. Now, if you've enjoyed this video, please consider giving this a like, because it helps to spread this video out and helps to keep me motivated to keep putting out quality content for you guys as well. Also, please consider subscribing so you don't miss out on any new videos, any key updates that could potentially help you in your investment journey. Again, I only ever put out videos that I believe that I would like to see myself as a retail investor, so you don't have to worry about crap content. Now, if you're still not convinced, then let's look at the other big powerful force beyond AI, government policy, right? Because here's something that most investors miss. The Fed and Treasury cannot afford to lose control of the long end. Besant has already hinted at it multiple times outright manner. If 10-year yields start rising uncontrollably, the entire system will feel it. Higher mortgage rates, higher corporate borrowing costs, higher government interest expense. So the government won't just sit back and let the long end run away. The Fed still has tools, Operation Twist, maturity swaps. The point isn't whether they'll use them now or use them tomorrow. It's that the threat and power of potential intervention itself that will keep a lid on 10-year yields. And that is what we call the intervention put, right? Just like how there was a Trump put, a Fed put, saving the stock markets, there is an equally powerful intervention put, saving the bond market. Now, while policymakers are quietly capping the top, foreign demand for treasuries is actually building a flow underneath. Yes, post-Liberation Day, we all know that countries like Japan, China, they have actually slowed down or even trimmed their US Treasury holdings, right? But when the Fed starts cutting and FX hedging costs for these global investors collapse, suddenly the 10-year interest rate, the 10-year Treasuries become attractive again to Japanese insurers, European pension funds, sovereign wealth funds. There's going to be a new wave of buyers stepping in, right as domestic investors are also rebalancing, right? This brings us to the Great Rotation. For the past 2 or 3 years, the easiest trade in the world was T-bill and chill, right? Just park your cash in the short-term T-bills, earn 4 to 5%, no risk. But once these front-end yields start dropping, which we have already seen in action now, trillions sitting in money market funds, where do you think they will go? Yes, maybe part of them will go into stocks, but the majority of them are going to move out further in the curve to lock in longer yields. This is not a one-off trade. This is a structural trade that is going to start. You'll probably hear people saying return of duration demand. What this really means is that the bond bear market is ending and the capital rotation is starting. Now, I know you probably often hear, but what about the rising US budget deficit? Wouldn't that keep long-term yields high? Good question. That is, of course, the number one thing that people are talking about. Let's actually break it down using facts, okay? Yes, the US carries a very large debt load and deficits have been structurally elevated. But this is not a new problem, right? They have been priced in for years, and the marginal impact on long-term yields is actually small compared to other forces. Let's look at what has actually been happening to the deficit. Yes, it's been growing a little over the past few years, but as a percentage of GDP, the growth is actually almost negligible, right? It's much better than what people are making it out to be. Second, yes, you probably hear a lot of reports of Trump going to spend his way out of recession. There's going to be a lot of spending. But spending is only one side of the equation of government deficit. If you look at what happened the past 2 years, right, even though spending has rose, the deficit hasn't really gone up much because there's also the part where the government is collecting tax revenue. So, the narrative that the deficit is exploding and therefore yields must go higher, that's a big big overstatement. So yes, the deficit argument, while valid, is not the dominant driver of long-term yields to come. The biggest drivers are still going to be growth expectations, inflation path, policy tone, and those, as I have mentioned, are more on the downward path, not upward. So at this point, if you are convinced as well that long-term interest rates will likely go lower, not higher, so how do you as a retail actually lock in these 4% high long-term interest rates right now before it drops? So the easiest way is to actually buy US government bond ETFs. You have the option of SHY, IEF as well as TLT. They give you exposure to US government bonds ranging from 5 years all the way to the ultra long end 20-30 years, right? So by buying this, you actually get the interest rate coupons even if nothing happens. And if interest rate actually goes down, you will get capital appreciation. But of course, if it goes up, you will have mark-to-market losses because the price of these bonds will go down. But as we have discussed earlier, that's a much less likely scenario than interest rates going down. So in conclusion, this is not 2021 anymore, when yields were artificially suppressed near zero and had nowhere to go but up. This is 2025, where it's the opposite. Real yields are at multi-decade highs, while inflation expectations looks to be normalizing, and the long end is actually trading at panic valuations in my view, while growth and employment data are already softening. This combination, high real yield and what looks like a potential cyclical slowdown, has been the formula for every major bond bull market in history. And that's all we have today. Hope you enjoyed this video, and if you have opinions you'd like to discuss, please leave a comment. Otherwise, if you like this, please give this video a like and subscribe to this channel so you don't miss out on any big trade ideas that could potentially help you make your next bucket of gold.